Well, now, this is the big question now. Should you buy an apartment or should you invest the similar amount to a treasury bond? So which is which? This is the big question because a lot of people are asking me, especially people from the diaspora. By the way, thank you very much, people from the diaspora. They are really calling me, asking me these questions because, hey, they would love to invest somewhere and they want to get the best deal out there. Never forget this. I always give this hint. Always put your money where your mouth is, or put your mouth where your money is. Whatever it is easier to move for you, just make sure the two meet, your mouth and your money. All right, now here's the point. I'm gonna take you step by step. We're gonna dissect two things. Which is it? That is the treasury bonds. Okay, treasury bonds, and specifically we're gonna talk about the IFB, that is the infrastructure bond, and we're gonna compare this investment method with doing what? With buying an apartment. And then we're gonna ask ourselves, now, which is the best way to go in terms of how much are you getting at the end of the day? I mean, seriously, at the end of the day is how much you get, all right? And also have to consider the securities and such kind of things. Anyway, by the way, if you're watching me for the first time, this is Joseph speaking. My name, I talk about everything related to investments. Okay, my name is Good Joseph. All right, so anything related to investments. And by the way, if you don't want to miss one of my good videos, I usually post a video each and every day. And there's some of you who are watching my videos and you have not liked also, as well as subscribing. Down below there is a small button written subscribe. Hit that magical button and also like the video. By the way, it doesn't cost you anything, just liking the video. Imagine I'm sharing all this information for free with you. Let's get to the business. Now, here we are. We have two things here we have to invest. And obviously, when we talk about buying an apartment, see, buying an apartment, obviously, we are talking about millions, okay? We aren't talking about hundreds of thousands. Let's talk of about approximately 5 million. Let's just use that example, 5 million, okay? Let's just use an example, 5 million. 5 million, that is in Kenyan money, that's around 40 something thousand, 40 something thousand USD or something of sort. But obviously, I know 5 million buying you an apartment is quite an average place. Honestly speaking, if you want to buy an apartment in Kenya, you really need like a minimum of 10 million. Honestly speaking, you need like a minimum of 10 million, okay? That's a reality. Now, the question is this. When I say an apartment, people sometimes don't understand what is an apartment. An apartment is whereby you go buy a unit in a very big, people think like when I say apartment, like a buy a flat. No, not really that way. I'm not viewing from that perspective. When I say buying an apartment, I mean like you going to somewhere like Kileleshwa or Kilimani, go buy like a 2-bedroom or 3-bedroom or something of sort, then you decide to go and rent it. Excuse me, you decide go and rent it out there. Okay, so but anyway, if you'd like us to spend whatever the amount of money, but let's see what exactly are you getting the best deal out there. Okay, let's get to the business now. Here we are. First of all, we have to ask ourselves, there is one rule of investments when you're buying the apartment. It says whenever you invest, you are a million bob. If you invest 1 million, if you invest 1 million Kenyan shillings, the return should be 10,000 at the end of the month. I repeat, if you're an investor and if you want to do something, if you're getting yourself into a million bob in terms of the investment, it's not giving you 10,000 minimum as far as the investments or other returns are concerned, then that is not the best investment that you can ever get yourself into. So it is good to make sure that at least you understand that investment that should give you a 10,000 at the end of the month. Now, we have the 5 of them. We have the 5,000 for us out there. I mean 5 million out there. So it means that if you were to use the same formula, it means then we have to get ourselves something. We have to get ourselves something called 50,000 if you were to invest the 5 million in the same case using the same formula and using the same understandings. That's for a fact. By the way, and it's true because, for example, if you take this 100,000 Kenyan shillings and you go and invest in a money market fund right now, approximately money market fund right now is giving you 13%. So 13%, this is pre-tax. This is pre-tax. So if you do the post-tax, the post-tax will give you at around 10%. So the 10%, again, it goes with the rule of 10,000 Kenyan shillings at the end of the month if you invest 1 million. Oh, and by the way, have your calculator with you. I got my phone here, so I'm gonna use this calculator because we're gonna use a lot of calculations here. So if you're not good with mathematics, oh, bear with me. This is all about mathematics, okay? Now, here we are. So we did this an apartment. So we have person A. We have the person A who went and bought the treasury bonds, and we have the person B who decided to go the apartment way. So the guy goes with the 5 million, buys an apartment. Let's say maybe it's a 1-bedroom or yeah, let's just call it maybe 1 bedroom in a quite an elegant and a posh area, and he's managed to actually go ahead and fetch around that amount of money, the 5 million at the 50,000 at the end of the month. Or you can decide to take the similar 5 million and go build, maybe let's say you have an existing piece of land or a parcel of land, you go and build like 1 bedroom. That can give you like approximately 7 units of 1 bedroom. Let's say 7 units of 1 bedroom, and maybe let's say around 7 units. Then 7 units gives you per month, maybe they say it gives you like 8,000. So 8,000 per month, that gives you like 56k a month. Now if it gives you the 56k a month, obviously you have to pay taxes and all those kind of things. Let's say it goes down all the way to 50,000. Now you see the magical number that I was talking about. So at the end of the day, the 1,000 million bob should give you a return of 10,000. Okay, now here you have your 50,000, or just call it like 52 or 53. Now that is the investment A. You go invest, you go build your houses, or you go buy an apartment. Now let's go with the treasury bonds and get to see exactly what happens. First of all, one thing that you're supposed to understand with the IFB is usually what? IFB is usually what we call tax-free. It is tax-free, meaning you don't pay a dime once you get the interest out of it. Okay, and right now as you speak, actually right now I'm making this video on February of 2022, or rather February 22 of 2024. That's when I'm making this video. And as I speak right now, in this month, there was an IFB, that is infrastructure bond, that was floated and as well as closed, and it closed at an interest rate of 18.4. For those who follow up my videos, obviously they are aware of such an occasion or such an occurrence. Okay, so it is at 18.4, and guess what? This is tax free. Okay, therefore it means that if you were to take your 5 million, invest in this infrastructure bond, which is going for a period of 8.5 years, okay, but does not mean like from today we ain't gonna have any other infrastructure bond. No, this thing usually happens a monthly or at a monthly basis. Okay, now here we are, we have our 8.5 million, and then let me just rub here so that we can have a space where we can be able to write, so that we can all be able to see. Now here we are, you have an infrastructure bond that is going for 18.5. now this is the 18.5, rather 18.4%. this is the coupon rate. Coupon simply means interest rate, so interest rates. Okay, interest rates. Therefore it means that if you are to invest your 5 million, then it will be 18.4% of 5 million. Okay, let's do mathematics on that. For those who have calculators, how much did you get? 18.4 of that. That gives you around 920,000, if I'm not wrong. Let's give you 920,000. It's around 920,000 or something of sort. Then this is yearly. This is per year. This is yearly. This is what you get at the end of the year, because the 18.4% is usually per annum. We call it per annum. Now the question is this: we want to tailor down this one until we get to realize how much are we getting in terms of the monthly basis. Okay, now we take the 920,000 divided by 12, we get ourselves approximately 76,000. That's what we get, 76,000. Now the question is this: if you get the similar 5 million, you buy an apartment, you go get 50,000 at the end of the month. You go buy the treasury bill, or rather treasury bonds, which an IFB like the one we had at 18.4%, you're gonna get yourself 76,000. And guess what? This is the thing that you have to understand. When you do buy the apartments, obviously you are assuming there is a rental income that comes all the time. There is nothing like, hey, there is no tenant, there is no renovations, there is not, like, you're getting clean from day one to all the way to day 365. Everything is good and everything. You get what I'm saying? So there are some of the factors that you have to hold constant. Now on this matter, on the other hand, is that you realize that the same amount of money, you ain't gonna make any call, you ain't gonna follow up, you're gonna do all those kind of things. The 76 G's get into your pocket. I understand this may go for 8.5 years and then it's over, but the apartment gonna be with you like forever. What you can be able to do is go ahead, maybe after getting this amount of money, if you're getting this amount of money each and every month, By the end of the year, you have like 920,000. The other year, you have 920,000. So if you were to do 920,000 multiply, let's say this is the amount of money that you set aside for the purposes of investment. You multiply by 8.5 years. 8.5 years, then you tell me how much you're going to be able to get out there. All right. Now, you ask yourself, now, what exactly are you going to do with that amount of money you're getting as an interest? You can actually do something called rollover. There's something called rollover. Okay, rollover, you can decide, hey, guess what, instead of me getting the money, you can plow it back. You plow it back. See, no, now these are some of the nitty-gritties that you really have to consider before making a single decision in terms of investment. You compare variety of options in terms of investments. And I agree one thing, okay, I am not encouraging that people should not go buy apartments, people should not build. No, there are two things that you're supposed to understand here. Okay, number one, we have two types of assets. Okay, we have types of assets. Okay, these types of assets, we have the soft assets, and this soft assets is what I'm talking about. Getting into a MMF, getting into a treasury bills, getting to a treasury bonds, getting to things like rates and all those kind of things. Those are called the soft assets. And then we have the B, that is the hard assets. The hard assets, now this is where most of the people are familiar with. This is like building an infrastructure, a structure somewhere, like buying that apartment, like buying piece of land and doing some value addition, like coming up with rental incomes and all those kind of things. And guess what? Both of them are okay, as much as one may have better returns compared to other based on this time. Depends on where you're watching this video, because I'm referring to the 18% that we have as of now. Both of them are important. It is good to have, because hey, there's one thing that you're supposed to understand. The moment you have your soft asset, your money is actually at your disposal. You can actually access this money, because even this money that is on the treasury bonds, you can actually go ahead and sell that bond on a secondary market. You can recoup back your money. You can be able to go ahead, like you have the ability, you have what we call the cash flow muscles. Like you can access your money anytime you want. Okay. The hard asset, on the other hand, may be a little bit hard for you to access the cash, and therefore it means that, hey, this hard asset, you have to liquidate it for you to sell. You have to sell it for you to be able to recoup back the money that you're looking forward into getting. So these are examples of the nitty-gritties, and obviously all of them have some shortcomings. You find like these hard assets, they have things to do with like renovations, paying taxes, and all those kind of things. The soft assets, again, we have to bank on the stability of the government. We have to bank on the stability of that capacity of that government to pay our coupon interest and all those kind of things. So what happens is this: if it's not a question of picking this one and leaving the other one, it's a question of, hey, if it is possible, have both of them at the same time. Remember one thing, I always encourage this: it's good to diversify, and also it is good to make sure that you contact your financial advisor, so that at least they can be able to tailor down that specific thing that works for you, because all this may not work for everyone. So you might think like everyone should you might think like I'm saying like everyone should switch off from whatever they are doing and concentrate on this type of investments. No, you have to contact your financial advisor and ask them, hey, guess what, I have this option, I have this option, and I have this option. Okay, fine, those are the options that I have. Then this is what I'm looking to getting. Okay, now you compare what you have and what you want and where you are, so that at least you can come up with a very good tailor-made and customized solution for your occasion or for your problem or challenge that you're having at that particular point. So from me, where I am, based on the interest rate that we have as of now, again, I said I'm making this video on February of 22nd, that is 2024. This is the types of the interest rate. I know this interest rates may vary from time to time, because honestly, this is not what we had like last year. So it changes with time to time. So my information may not hold constant like forever and ever and ever and ever. I hope you're approaching this message with utmost intelligence for you to understand what I'm trying to compare and contrast as we move to the next level. Now, guys, guess what? That is my summation on what should be the best in terms of investment. And obviously, if you go by, interest rate, obviously bonds is far much better compared to investing on the apartments. And if you go for, you are more much inclined towards the hard assets, therefore going for the hard asset way or going the apartment way, that one may be far much better to you. Anyway, guys, that's the end of my video. And by the way, I know you're like, hey, can someone contact you, Joseph? Absolutely, yes, you can. And how do you do that? My number is always on the description of this specific video. See, just below my number of views in terms of this video, just below it, there is a button there. Just click that button, then you're gonna see a description. whole of a description there. You're going to get my number and my email is out there. Shoot me a call or text. Then we can be able to have a discussion over that for just a cup of coffee's price. For now, it's a goodbye and see you